What's up everybody, Nate here, and 3 out of the 4 major banks in the United States are signaling a potential recession in 2023, and they're now warning Americans that they need to prepare and pay attention starting right now. These warnings are coming from the banks Wells Fargo, Bank of America, and JP Morgan Chase, and of course from their CEOs. They're basically saying that there is going to be a huge consumer shakeup in 2023 that is essentially going to plunge us into our next recession. Brian Moynihan, the CEO of Bank of America, is saying that there's going to be a huge consumer slowdown coming, and also the CEO of Wells Fargo is saying the exact same thing. They both believe that while consumer spending has been pretty strong over the last couple of years, it is going to slow down in 2023 because of 2 major things. The first and foremost is inflation. Now, inflation basically has eroded the value of our money over time, and it's meant that prices in just about every single sector have gone way up. And with prices going way up, American consumers, well, they just don't have the money in order to keep up with those price increases. So they just don't have enough money in order to buy all of the same things, which means in 2023, they're most likely not going to be buying all of the same things. And Wells Fargo and Bank of America see that first and foremost because they hold and watch over millions upon millions of American savings. These major banks in the United States can literally look at, well, how are Americans saving their money? How are Americans spending their money? And what they're seeing and what they're noticing is that Americans are draining their checking accounts every single week, and they're not putting enough into savings. Savings throughout the United States have been growing marginally over the last 2 years, largely fueled by the stock market booming last year and stimulus payments. There is roughly $1.5 trillion in all savings accounts in the United States, something that Jamie Dimon, the CEO of JP Morgan Chase, says is going to be depleted by the middle parts of next year. Jamie Dimon said, quote, "Inflation is eroding everything, and that $1.5 trillion will run out sometime mid next year. It may very well derail the economy and cause a mild or hard recession that people worry about." So basically, from Jamie Dimon's perspective, he's looking at the numbers from his particular bank, and he's noticing that, yeah, people have been spending a lot of money in 2022, and that has kind of made sure that our entire economy has stayed on top of things despite this big inflation problem. But it's because Americans have had a lot of excess money because of stimulus payments and because of things like the Great Resignation. Many Americans got a new job, which means they were making a whole lot more money, and they got raises in 2021. And like I said before, stimulus payments meant a couple thousands of extra dollars went into Americans' pockets and into their bank accounts. We are still seeing a lot of that spending going on, but with inflation continuing to hang around, Americans are just going to have to spend more and more and more of it. And once that $1.5 trillion runs out, now we're going to be in a problem because Americans are not going to spend all of their cash all the time, and when they run out, they're not going to spend any money anymore. That means if Americans do have some money in their savings account right now, well, then they're spending their money. But if they're going paycheck to paycheck and not having anything in their savings and they don't have anything in their checking, well, then what exactly do they turn to? This was the next big question posed by Wells Fargo and Bank of America. They're also starting to see credit spending go down as American savings accounts also get depleted. Americans in the United States, well, they treat that credit line on their credit card or loans as an extension of their salaries, right? But as inflation goes up, as the Federal Reserve raises its interest rates, well, all of that credit and all of that debt just gets a whole lot more expensive, meaning if Americans are living paycheck to paycheck, now they have to spend more money of their paycheck on those bills, which depletes their checking account even more, depletes their raise and any money that they got from stimulus checks even faster, and they can't put any money into savings. So they're basically one disaster away from financial ruin. This, according to Jamie Dimon and the CEOs of Wells Fargo and Bank of America, is going to cause some rippling effects in 2023 that could send us into a recession. Spending has gone up this year. It's actually increased overall for debt payments and just spending in general by around $4 trillion in the United States alone, which is an incredible number. But in November, one of the biggest shopping times of the year, spending only rose by around 5%. And what consumers are actually buying isn't consumer goods anymore. It's actually services and experiences in things like the travel industry industry. That is where the majority of Americans are spending their money right now. But unfortunately, most of our economy is not made up of a lot of those travel and a lot of those experience industries. It's made up of goods and services. So without people going to restaurants, without people actually buying things, that cripples our entire economy. So that is sort of the first part that a lot of these banks are kind of signaling a warning on, right? Is the inflation side. Inflation is going to continue to be around for a very long time, and that's going to erode spending in the United States, causing spending to go way, way down. And when spending goes way down, businesses don't get any sales, so they don't get any money that they need to grow. They start going down, and all of their investments start to go down too. What a lot of Americans don't realize is these businesses and these banks are not just one thing, right? Everything is interconnected via globalization and the stock market. So if a company like Amazon starts to lose billions upon billions of dollars because Americans aren't buying as much anymore, that means all of the equity that Amazon has in other smaller companies and startups also starts to dry up, and that sends a domino effect all throughout our economy. The second thing that these banks are kind of warning people to pay attention to is the Federal Reserve. Now, the Federal Reserve has been raising interest rates all throughout 2022, and the reason is because they want to bring down demand. They want to make it a whole lot harder for people to take on credit and to get into debt in the United States. So they raise their interest rates, which puts a little bit more pressure on the banks to also raise their interest rates, because the banks get their money from the Federal Reserve and the federal government. So with the Fed raising their interest rates, the banks raise theirs, and hopefully less people will take on credit, and that means less people buying things. Less people buying things means demand goes down, and thus you have lower inflation. So with that being said, the Federal Reserve has been raising its interest rates, and right now the federal funds rate sits at right around 4% in the United States. This is up from 0% where it was over the last couple of years. That's part of the reason why we've had all of this economic expansion, and boom, all at once. We had businesses and banks and investors pouring money into anything and everything they could find because everything was an easy opportunity to make money. And like I said, you had lots of businesses hiring lots of people, raising salaries because there was just so much excess in our economy. Well, now all of that is slowly getting wrung out and could end in 2023. Jamie Dimon believes that the federal funds rate is going to be right around 5%, and the Federal Reserve has actually mirrored this exact same sentiment. They believe that 5% is where they need to get to in order to really start to bring down inflation. Now, inflation in the US is currently at around the 7.7% mark, and it's supposed to be at around 2%. So it is much, much higher than it needs to be, which means the Federal Reserve, in order to bring out that demand, needs to continue to raise interest rates much higher, because with inflation still staying high, even though they've raised their interest rates, it's pretty clear that they haven't gone high enough. The worry from bankers like Jamie Dimon is that interest rates, while they might hit 5%, that might not be enough in order to bring down inflation because people have so much excess money. Even though you're going to cut off business expansion, even though you're going to lower and limit and restrict our entire economy in terms of people going out and getting mortgages and other types of loans, you're still not really going to be battling the inflation problem because people are going to continue to be overspending every day, which may actually trick the Federal Reserve into raising interest rates even higher and restricting our economy even more. The Federal Reserve has one tool to kind of combat and grow our economy all at the same time, and that is interest rates. Raising their interest rates, which is exactly what they're doing now, lowers that demand because it's way more expensive for somebody to get a mortgage. I mean, if interest rates were at around 2% for you to get a mortgage, well, then you're going to be saving hundreds of dollars. You're barely even going to notice that interest rate at all on your mortgage. But suddenly, when interest rates hit 5, 6, and 7%, now you are going to be spending hundreds of additional dollars for a mortgage simply because the interest rate is higher. The same priced home and the exact same model home is going to cost you a whole lot more. So Americans simply can't afford that, and they're barred out of getting a mortgage. And the same can be said for businesses taking taking on and trying to get credit in order to build their business. And the same can be said for investors trying to invest money and get a return on that investment. Nobody is going to invest money if you have to get a 5, 6, and 7% return guaranteed in order to break even. No, investors want to make double what they're putting in so they can continue to invest more and grow our economy and not put themselves at such a big risk. Basically, the Federal Reserve may need to increase its interest rate hikes even more than anticipated in 2023 until people stop spending money. The other thing, of course, is for them to lower their interest rates. And when they lower their interest rates, well, there's tons of economic expansion, right? Like we saw over the last couple of years, anybody and everybody can get a home because they're saving so much money on that interest rate. People are going to spend money on credit cards. People are going to go out and get auto loans. Investors are going to pour money into a business because, well, if interest rates are at 0%, they now just need to get a 2, 3, 4, 5% return on their money, which is not all that difficult to do. It's a very easy sell for everybody. Of course, then you have economic expansion, but all of that creates a lot of inflation because now there's way too much spending all at once. And there's an argument that we may have needed all of that over the last couple of years because of the pandemic, but the bottom line is the Federal Reserve may restrict the economy way too much because there is overspending and too much saving going on. What that could cause is a lot of unemployment to go way higher, way quicker, because now you have businesses who are not getting the sales because inflation is too high and Americans aren't spending that much money. Meanwhile, consumers are spending just enough to keep inflation high, so the Federal Reserve raises its interest rates, and businesses and investors can no longer get that credit or investor money that they need either, so they start shrinking and try to do whatever they can to save their business, and that involves cutting costs. Cutting costs may be laying off people or straight up firing people, and that might be a big problem in 2023 because now Americans are going to spend even less. And to be honest with you, that's kind of what the Federal Reserve wants. They realize that businesses may have overhired people in 2021 and they may have overpaid them when they hired them. So now you have thousands of businesses who have hired millions more people than they probably should have, and now there is way too much spending in our economy. The Federal Reserve wants that to go down because if people don't have a job, then they can't spend money because they don't have an income, meaning demand comes down and thus inflation. One little caveat that I want to add on to this video is the bias that banks have too, because you got to realize when the banks say, oh, we're going to have consumer spending go down and that is going to be a big problem for our economy. Well, to be honest with you, we don't know how far consumer spending is going to go down yet. We don't know exactly what is going to come in the future, and the banks don't know that for sure. They can only look at the trends that are happening right now. They can't project future trends based on what exactly is happening. Our economy is very fickle and everything is very connected, so one thing growing or one thing going down could affect something else. And to be honest with you, the banks want you to spend money, right? The banks want you to go out and get credit. They want you to go out and get a loan. They want you to go out and try to get a house because if they tell you things are going to be bad in 2023, you better do something now, save your money, spend on credit cards, etc., then they get a whole lot richer, and that is really good for them, especially when it comes to you saving your money. The banks take this savings and they lend it out. Everything that you save, the bank lends out a portion of that to invest or to loan out to somebody else trying to get a mortgage. The more you save, the richer the bank gets. So yeah, they do have an implicit bias here trying to say, well, Americans should save their money because we're going to have all of this savings account depletion in 2023. But they're not exactly wrong either. If you have nothing in your savings account, then yeah, it might be time for you to start saving money. That might be very, very important in the future. The banks do have a really interesting perspective on this because they see how consumers are spending their money. They see how consumers are saving their money. So they have firsthand knowledge of what could potentially happen in the future. But like I said before, nobody has a crystal ball. Nobody can tell you for sure what exactly is going to happen in 2023. And that is why you need to prepare your finances accordingly so that you are prepared for no matter what happens. Like I said, a savings account is going to be key. If you don't have anything in savings, then that should be your number one concern. We don't know if we're going to have a lot of job loss or unemployment or how much things are going to cost. So you don't want to have to put things on credit and you don't want to have to take out loans. All of those things are just going to get more expensive, which eats away at your income every single week. You want to be able to save up for the things that you want and need. So savings is number one. Number two, be thoughtful about your purchases. expenses. This is not the time to go out and buy a mega mansion if you just got a brand new job, right? Everything in our economy is very fragile, so you have to kind of consider what you're buying every single time you walk into a store or try to get a loan. And 3, do not stop investing. I know it kind of seems opposite right now because the stock market is very volatile, but investing is going to be inflation. It's going to mean that your money is gaining more value over time instead of losing value. So no matter what happens, you'll be making more, your money will be growing over time. And if you do all of these things in the right way and start preparing now, then you probably won't have to worry about the next recession, because our economy unfortunately goes through cycles, and we could potentially see another recession in the future and another one. These things happen all the time. The difference is how prepared you are. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.